What's going on, guys? Today we got a great episode with John Pompliano. In this conversation, we talk about what's going on with Bitcoin, gold, AI stocks, the Fed, and of course, the market. We're trying to figure out, are we going up? Are we going down? Should we be worried? Should we be allocating? Why are retail investors at such an advantage compared to institutional investors? And how are asset prices going to do going into the end of the year? All that and much more in this conversation with John. Before we get into the episode, though, I need your help. My goal is to get to 1 million subscribers on YouTube, and that's where you come in. Right now, we have about 632,000 subs, a little bit more than that. My goal is to get to 1 million. We're so close. So hit the subscribe button, help us get there, and let's get into this conversation with John. All right, John, what's the first topic?
All right. Gold, best performing asset over the last 20 years, up 11% annualized return.
Congratulations to the gold bugs. I'm very happy for them. I think that gold bugs understood before most what was the problem in the traditional financial system, which was they are going to debase the currency. Hard assets are going to do well. The stock guys, they were yelling and screaming. They were all celebrating because they thought they had these productive things that were going to outperform non-productive assets. Didn't happen. Gold bugs do not get enough credit for not only one, buying gold, but the harder thing is if you bought gold 20 years ago and didn't sell, you took it to the chin for years of people making fun of you. Why do you have that gold? Oh, you're just some old crazy person. Why are you still holding this thing? It doesn't go up. It's stable, whatever. I've jumped in on the gold bugs at times. If you've held gold for 20 years, congratulations. You were right. You deserve all of the returns that you're getting. Now, what I will say is still only up 60% this year, which yes, that's a lot for this year. But if you go back and you look at what was gold trading at in, I don't know, 2020, it's up 150-ish%. Bitcoin's up 1,500%. So let's just put it, just for my Bitcoiners out there, let's put this all in context. But gold bugs still, they should get plenty of credit. And I think what it does is it calls into question, why is it that a non-productive asset has beat the productive assets over 20 years? And so I recently wrote this whole thing about Peter Lynch. Peter Lynch is famous, one of his best quotes ever. You spend 13 minutes on economics, you have wasted 10 minutes. Banger one-liner. That guy was made for Twitter. He would be going viral every day with the one-liners. But that was back when he managed the Magellan Fund at Fidelity. Well, guess what? That was from 1977 to 1990. GOAT. Best performing mutual fund at the time in the world. He had a 29% annual return. Destroyed the S&P 500. But the problem is that back then, you didn't have to pay attention to macro because you could buy these businesses. And if you bought businesses with good fundamentals, they would continue to appreciate in price. All the macro stuff would kind of work itself out. Now what we have, though, is we have a market that has been broken. 2008 was the breaking of the market. 2020 was the acceleration of the market. We have a currency that is debasing. It's lost 30% of its purchasing power since 2020. Macro is all that matters. And so that is why you see risk assets and safe haven assets all going up at the same time. And so it's not so much that buying a good company with good fundamentals at a good price, that's of course always going to be a good strategy. No one is hating on value investing or any of that stuff. Those people are smart. They're going to make money. But actually the more important thing is the environment in which it is operating. And now that you have these global central banks, you have this money printing, you have this national debt issue, you have the currency debasement, all of that is showing you the environment, the macro stuff matters way more today than it did, let's say 50 years ago. And that's why gold has outperformed for 20 years is because it was more of a macro trade than it was any individual stock.
Right now, it seems like a debasement trade.
Well, the debasement trade is kind of like this new word that Wall Street came up with because they wanted to see the thing about Wall Street. Here's the whole thing is you get to claim credit for an old idea if you give it a new name. That's how it works, right? If you take an old idea, you just kind of, spit shine on it, put a new name on it, you get a call. So what used to be the sound money trade or the gold trade or the Bitcoin thesis or whatever, all of a sudden people said, well, what if there's some genius on Wall Street? What if we call it the debasement trade? And the second they called it the debasement trade, bam, new thing, shiny, go, phew, capital flows. So they're just doing what they're incentivized to do, but it's no different than what Goldbug's been saying forever. I mean, Peter Schiff, if you go back and you listen to what he was saying in the early 2010s, that man is saying the same stuff today. right? Now, it took 15 years for him to be right in terms of gold really making a big move, but it doesn't mean that back then he wasn't right. And so sometimes the market takes a long time. Warren Buffett the market is a voting machine in the short term. It's a weighing machine over the long run. Well, the weighing machine is telling everyone gold is actually really valuable and it is a solution in someone's portfolio for the macro environment that we're in. Bitcoin, obviously, similar thing. But for 15 years, 18 years, these people were mocked, ridiculed. They were like the bastions of the financial system. And people just put them over in the corner and said, that's cute with your little pet rock. They're winning now. Congratulations to every single one of those people.
So obviously in the 1970s, we got off the gold standard. Do we go back on the gold standard, do a combination of gold, Bitcoin standard? Obviously, Bitcoin's a younger asset with a little bit more volatility. Well, I guess gold. So
there's a couple thoughts. There's a couple thoughts here. I think that we are more likely to go to a Bitcoin standard in the Western world than a gold standard. And we can talk about why. I forget. I talked to a lot of people, so I forget who said this. This is not my idea. This is Jordy Visser, Jeff Parks, somebody. Maybe China is trying to go back onto a gold standard, though. Could there be a bifurcation in the East versus the West? China's been aggressively buying a lot of gold. Now, are they going to actually peg the currency to gold? Well, that's a little bit harder to see, but they could try to do that. But they're just filling their reserves with gold, right? So in a way, it is a backed currency, right? The reserves are gold. Now, the pegging, I think, is a little bit different. So I think that the United States is very forward-looking, very technologically innovative, and I believe that we are not going to sell a bunch of gold to go buy Bitcoin. I don't see a world where that happens. I think now if you were to value the gold that the United States has at market value, it would be $1 trillion. That's a lot, right? But if you also look our debt's pretty big.
34 trillion.
I think we're at 37 or 38 trillion now. Yeah. So, just think about that. You didn't look for a week and all of a sudden, it increased 10%, right? So I think that there's an issue there as to what is the United States going to do. Now, I do not see the United States going and buying a lot more gold. I think that there's a drumbeat of people saying go and buy Bitcoin. In a way, the United States is acquiring more Bitcoin. There's this recent story that came out. They call it a pig butchering scheme. Now, just to be clear, when I first saw the headline, I was like, damn, somebody was butchering pigs? That's crazy. Then you read the article and you're like, no. They were basically calling the people they were taking the money from, they were butchering pigs, right? So it's not actual animal cruelty, PETA, relax. Instead, it was them taking advantage of people online, running scams and stuff like that. Probably why you get so many spam calls. And so from there, the United States was able to get, I think it was something like $15 billion of Bitcoin, whatever the number is. And they put that into the Bitcoin and strategic reserve. So in a way, the United States over the last 2 months has acquired another $15 billion of Bitcoin. They just didn't spend any taxpayer money to do it. So, I've got some mixed feelings here. On one hand, the United States having more Bitcoin in terms of the perception of the United States strength, that is good for the United States of America. Is it good for Bitcoiners, for nation states to hold tons of Bitcoin? Well, it's inevitable. They're going to go and do this. But I think part of the beauty of Bitcoin is that the system itself, the network is decentralized, the nodes, the miners, the holders, et cetera. But also ownership has been very centralized. And so I don't think we want anyone. I don't think we want a public company. I don't think we want a government. I don't think we want anyone owning 10% of the supply as an example, right? I think instead what we want is we want decentralized ownership of this thing as best as we can get it. Now, the balance is the free market ultimately determines that. So it's everyone's responsibility to go and acquire whatever Bitcoin they want so that other people don't get it, right? And so the incentive kind of takes over. So even if you take something like strategy, right? On one hand, you're like, oh, one company has all this. Well, technically that company is made up of lots of shareholders, right? So if you think of it from that perspective, it's a lot of people who pooled their money to go and buy the Bitcoin, not just one business, or one person going and doing that. Now, if you bring it back for a second to this idea of going back on the gold standard, I do believe that there is a psychological scarring that occurred in 2020 and 2021, where people just do not believe that fiat currencies have the staying power or the value stability that they once had. So kind of the cat's out of the bag. Now, can you go back to those people and say, actually, we are going to put you back onto a gold standard. We're going to back this currency with the gold. And don't worry, like the problem is not going to come back. I don't know. It's a very interesting question because on one hand, it's, what is it like? Fool me once, shame on you. Fool me twice, shame on me. Right. So same thing here is, are people going to go plow a bunch of their economic value back into a currency? Like the Venezuelan government or the Zimbabwe government, how many times have they come out with some new change to the currency? Like, don't worry, it's not going to happen again, right? Eventually people are just like, dude, we don't believe you. And so is the United States there? Probably not. Like, I do think that there would be a surge in confidence of the dollar if it was backed by gold, Bitcoin, some kind of asset. I just don't think we're going to see that happen because that would take away a lot of the value of the money printer. And so if you can't print more money, then essentially the United States, like kind of the fiat Ponzi scheme is over.
It's almost like holstering your gun. It's like no more
holstering your gun. It's like knowing that there's a bunch of criminals with guns in a location, not just holstering your gun, leaving your gun at home, getting in your car, driving over there with a big sign that says, I don't have a gun. Right. So, what do you think is going to happen? And so I think that it's just, we're on a path. And, I think it's Lynn Alden says, nothing stops this train. I don't think anything stops the train. And so on that path, what I think will happen is you're going to see people kind of reach for emergency, exits. And whether it's gold, Bitcoin, whatever, they're going to have to put that in their portfolio. Today's episode is brought to you by EasyBitcoin.app. They offer a simple, rewarding Bitcoin investment experience. With Easy Bitcoin, every recurring buy automatically earns you 1% extra in Bitcoin, and the sats don't stop there. Hold your stack in the app, and you'll collect a 2% annual reward, plus 4.5% APY on any US dollars you park in the USD interest account. You can even opt in to have your interest auto-converted to Bitcoin. It's a simple, set-it-and-forget-it way to grow your Bitcoin. Easy Bitcoin is live right now on iOS and Android. Hit pause, click the link in the description, download the app, and start earning while your Bitcoin stash grows. Your capital is at risk, crypto markets are highly volatile, and this content is informational and not financial advice. Today's episode is brought to you by Simple Mining. Have you ever been interested in mining Bitcoin? As a miner myself, I've been using Simple Mining for the past few months, and the experience has been nothing short of seamless. I mine with the pool of my choice, and the Bitcoin is sent directly to my wallet. Simple Mining, which is based in Cedar Falls, Iowa, offers a premium white glove service designed for everyone, from individual enthusiasts to large-scale miners. They've been in business for 4 years and currently operate more than 20,000 Bitcoin miners, including mine. Their electricity is over 65% renewable thanks to the abundance of wind energy. Not only do they simplify mining with their top-notch hosting and on-site repair services, but they also help you benefit financially by running your operations as a business. This approach offers 100% bonus depreciation to optimize the profitability of your investment. Do you ever worry about the completion of maintaining your mining equipment? They've got you covered there too. For the first 12 months, all repairs are included at no extra cost. If you experience any downtime, they'll credit you for it as well. And if your miners aren't profitable at the amount, simply pause them with no penalties. When you're ready to upgrade or adjust your setup, their exclusive marketplace provides a seamless way to resell your equipment. Join me and many satisfied miners who have simplified their Bitcoin mining journey. You can even get started today with a 7-day miner trial. Visit simplemining.io/pomp to get started today. That's simplemining.io/pomp to get started today. With Simple Mining, they make it simple.
Okay. Jordy Visser recently said on your podcast, the Pomp podcast on Saturdays, go watch it. He said gold's a fear trade, right? Everyone, if you're fearful, go buy gold. It's a sound money asset. Bitcoin is the complete opposite side of that coin, right? Bitcoin is looked at, hopium and going to go up over time. When you think about Bitcoin and stocks correlation to then gold, should everything go up as money gets cheaper, or will there be a divergence eventually?
Well, so this is the whole thing is this whole idea of like risk assets and safe haven assets going up at the same time. Historically, it's been pretty much the opposite, right? You see risk assets run, then people say, oh no, we're fearful, right? They come back in on the risk curve, and then all of a sudden safe haven assets run. And so, I always laugh that if you go back to November of 2021, we saw the market kind of turn over, and as people ran out of tech stocks and stuff like that, and they all started to fall, all of a sudden Berkshire Hathaway started hitting like new all-time highs. Again, not perfect, right? But the value investing kind of cash flow based business versus, more the tech type business. So I do think that there's this relationship between risk and safe haven assets. Part of the reason why I think that both are going higher right now that I don't see anyone really talking about is just that the base of investors in financial markets has gotten bigger. So there is this belief, which I hold, there's always good news and bad news in the economy. Just depends on who you're talking to. So that K-shaped economy, there are people right now who are like, this is amazing. Stocks keep going higher. I'm getting richer. This is awesome. And then literally, like on a subway train, you can walk over to the person right next to them and say, how's it going? And they'll be like, this is horrendous. I can't find a job. I can't afford a home. Literally I can't afford kids. Like this is everything that I don't want. Those two people exist in the same economy. And so that K-shaped economy is one is telling a story of, prosperity, and the other is telling a story of economic pain. They're both right, because there's a bifurcation in the market. Now, if you go and you look at risk assets and safe haven assets, same exact thing is happening. There are people who are making a lot of money right now on risk assets. They've pushed out on the risk curve and they're really allocating there. And those assets are going up. They're in all the AI companies and the tech companies and all that stuff. At the same time, the gold investors are seeing gold surge higher. So wait a second here. Why is it that both of these are going together? Well, there has been an explosion of capital market participants. There's this chart that recently came out of Interactive Brokers. They now have over 4 million account holders, and it's like a perfect line of growth, right? They just keep compounding over time, and they have more than 4 million people. Now, some people look at it and say, oh, it's a great business, whatever. That's all probably true. My takeaway from it is there are more people today with brokerage accounts and investing in the market than ever before. We're at an all-time high of market participants. There was an article in the Wall Street Journal recently that said more people that make, I think it was like under $50,000 or something, that are participating in the stock market than ever before. So at all income levels, you are seeing an increase in participation. Some of that is just like access to the internet. They see information, they start to learn, they realize they need to be an investor, so they start to allocate. A big part of it is also the tools are available now, whether it's the Webull's, Publix, Robinhood's, Coinbase's, whatever, like they're all going and they're investing there. And so when you see this, you start to say to yourself, hold on, it's not like we went and dug up 20% more gold last year, right? So there's only so much of an asset that is available. It's not like these public companies all of a sudden issued tons more shares, right? And so you have more people in the market, which means you have more money in the market. And so now all of a sudden you have some people who are bullish, some people who are bearish, some people who are on offense, some people who are on defense. And as they allocate their capital, you can actually see both assets start to go up. Now, why is that? Because the loser in that scenario is cash. It's bonds. It is the thing that people used to store tons of economic value. The quote unquote financial battery, which was cash, is being expended. People are saying the battery doesn't work. The battery, I put energy into it, and that energy dissipates very quickly. I wanted to store energy here for next week, right? But I can't actually power my home because the battery won't hold the charge until next week. So what do I have to do? I have to go find somewhere else to put the energy. And that's what you're seeing in financial markets is people are saying, I'm not going to just sit with my money in cash because it doesn't hold value over time. I need to get out. And so whether I'm defensive or offensive, pushing, getting that energy out of the quote unquote financial battery of cash is ultimately driving the market. And they're doing it because of all of the undisciplined monetary and fiscal policy.
Retail continuously buying the dip.
Yeah.
Over and over and over again, right? I think Cabosi had a great car. Adam Cabosi, great guy. Great, awesome company he's got going on. Cabisi, that's how you say it?
I usually mispronounce every single person's name, but that one was on you.
I do it all the time. Don't worry about it.
Yeah. Adam's a fan of the show.
Fan of the show.
Like we're a fan of him, I meant.
Yeah. $3.9 billion worth of stocks bought last week. As you think about retail investors, normally like it's great. You can trade from your iPhone, right? But as you look at those types of investors, they act much differently than institutions.
They're smarter.
Right? You think they're smarter? Why do you think that?
In some regards, absolutely. I think that if you give an investor a spreadsheet today, there are certain businesses where they will be able to identify opportunity that an investor without the spreadsheet can't identify. Right? Value investing is a great example. You need to understand what is the fair value of the business. What is the kind of asset value of the business? And if it's trading below that, then go buy it. You need a spread. Whether you use a napkin or a spreadsheet, you got to do some math. Right? I don't think that's really where the majority of the retail movement shines. Where I do think that the retail audience shines is momentum and dip buying. And you don't need a spreadsheet for that. In fact, if you have the spreadsheet, you may be at a disadvantage because if you go back to April, right? You and I are very fortunate. We got a lot of friends in a lot of different industries. I got friends that work at restaurants, that are doormen, that are police and firefighters, that are in the military, that are teachers, doctors, lawyers, and work on Wall Street and everything in between. And guess what? My smartest friends, they were all freaking out in April. My friends who, they kind of invest on vibes. They were buying like maniacs. In hindsight, who was right? The people who were buying. So if you went and you talked to them, which I did, I have one friend who called me. I'll never forget because he kind of spooked me a little bit. He was like, oh my God, this is going to just be like COVID again. I'm going to do this. I'm going to like, they were like slowing their wires out to vendors. They were trying to pull capital. They were worried about having to like lay off employee. I mean, just like mass changes inside the business. And I was like, man, am I wrong? Like, am I misreading what's going to happen here? And then I remember talking to one friend, and every day I talked to him during that whole chaos, he was just like, yeah, I bought more. I was like, where do you find all this money from? Right? Like, it's not like he's like super rich or anything. And he was like, no, he's just like, if the market goes down, he's going to go back up. He's like, I'm a young dude. Like it'll go back up. And so going back to this idea of like the spreadsheet, you could have calculated what the tariff rates are, where all the imports were coming from. You could have went and said, Canada and Mexico are our biggest trading partners and they're not going to like us now. And Ford's going to move their facility here. And then, all of a sudden, I see somebody tweeted from the UK that they're not going to do business with us. And none of it mattered. The faster stocks fall, the faster they recover normally. Study reflexivity. And retail investors have been convinced that that is true. And so guess what? They invest off of momentum and they buy dips. And that has been a great strategy. And so I think that the retail investors are in some regards smarter than the institutional investors because they also don't have the constraints. That's the other thing is that people forget. If you're sitting inside of a institution, you have, first of all, it's not your money. Usually, right? It's somebody else's money. So you have a fiduciary duty to those people. You can't just like YOLO buy on a dip. Second thing is that you have an investment committee. So all good ideas go to die inside of a committee. So if you're the guy who's like, hey, I think we should buy, everyone sitting around the table doesn't want to get fired if they're wrong. So everyone starts to hedge together, right? And you basically evolve into this world of like, let's wait, right? But actually the best investors, they're very, very courageous and bold at the right moment. And that takes the unilateral ability to execute an investment without having to go convince a bunch of other people because usually it's not popular at the time. The third thing is that they have all sorts of risk mitigation and risk limits for good reason, but they have those constraints where retail normally doesn't. Certain sizing requirements. It can't be, a single name can't be a certain size. There's volatility requirements. If, the pod shops are famous, if you're down like 5%, they'll take back half the money they've given you. I think if you go down 7.5% in most shops, you're out. Right. So again, what are you doing? You're hedged, you're, delta neutral, you're arbing, you're doing all these things because you don't want that downside draw. Right. And then the other piece is rebalancing. Right. They usually can't let their winners ride again because of the requirements. And so you just have all these things that put the institution actually at a disadvantage when you have high volatility. And that's where the retail investor, people are like, oh, they're dumb. Well, one, they're smarter than most people think, but also two is they're unconstrained. And so their participation in the market in an unconstrained way, I think better positions them to be able to drive returns and outperformance than if you sit within a risk mitigated framework where actually you may not be trying to drive the highest return. Like, I don't think many of the pod shops, their goal is to drive the highest return possible. Howard Marks, if you're willing to be the number one best investor every year, you also got to be willing to be the last investor in a given year because you've got to take such immense risk to be number one that if it doesn't go right, you'll end up being the last, right? And so the pod shops don't want that, right? What they want to be is they want to deliver kind of low teens return every single year like clockwork and do it with incredible lack of volatility and risk. Great. That they're serving a purpose. They found a customer in the institutional LPs and they said, I know what you need in your portfolio. That's a problem. I can solve it for you. What if I could deliver to you low teen returns with very, low correlations, low volatility, low risk per unit of reward, but whatever. And institutions say, let me hit that bid, I'll give you the money, right? So again, it's like they're optimizing for something else compared to the retail investor, where most retail investors I know, they're optimizing for pure alpha generation or outperformance.
Hi, I'm Matt Hogan, CIO of crypto asset manager Bitwise. Look, crypto can be confusing. There's so much noise and the space changes so quickly. That's why, every week, I write a 5-minute memo on the biggest stories impacting crypto in plain English. Why is Bitcoin up or down? What are people missing? Where should investors look next? Get the lowdown every week. Sign up to get the weekly CIO memo delivered straight to your inbox. Go to bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
100% agree. Speed, the ability to not have to rebalance and all those things are extremely important. But there's also the other side of the coin, which retail investors notoriously, they're chasing returns, right? I talked to some of my friends and they're like, 8%, that's it? 8%. I'm looking for low cap stocks that are going to, 2, 3, 4x, right? It's a different type of investing, but I also think there's a place for both, right? And when you think about who is investing on the retail basis, it's, the barber, it's the teachers, it's all these people. I don't think that they should be singling out personal stocks as much as they should be diversifying a little bit more, because I see people, everyone's a genius in a bull market, right? And when a bear market comes, things get ugly fast.
They do. But it also comes back to, if I go talk to institutional investors, one of the challenges is how well can they know their entire portfolio if you own 50 stocks, right? Like the level of research that you can do is actually pretty shallow versus, let's say, a retail investor that owns maybe 3 or 5 stocks and knows everything about those companies. Now, that's not true everywhere, right? There's plenty of investors who maybe don't have 50 stocks, they have 20 and they know everything and it's their job.
They have a million analysts under them.
Correct. Or there's plenty of retail investors who they've got more than 3 stocks or they don't really understand the 3 stocks they own that well, whatever. There's always exceptions. But for the most part, having a concentrated portfolio means that you can actually understand what you own much better, right? You're not required to relearn 50 businesses. And so, just again, like go back to the legends. I'd rather have, a basket of a few eggs and watch it closely, right? Concentration builds wealth, diversification protects it. Like these are classic, timeless investing principles that have been around for a long time. It's not rocket science. It's just that there's some, in politics, people talk about like TDS, Trump derangement syndrome. Mm-hmm. I'm going to label a new thing. I'm going to spit shine an old idea, and we're going to call it RDS. Right, which is retail derangement syndrome. The second you say retail investors are doing something, people's freaking brains break. They got smoke coming out of their ears and they're like, these morons, they're gambling, blah, blah, blah. Like, hold on a second here. Hold on. Everyone calm down, pump the brakes. They're doing, in many cases, the timeless investing principles, right? When stocks go down, they buy. They don't sell, right? Why would you sell if the market is going down? If you liked it yesterday and it's 20% cheaper or 10% or 5% cheaper, shouldn't you like it more today than yesterday? That's timeless investing principle, right? Buy things for less than they're worth. Timeless investing principle. Concentration builds wealth. Timeless just go down the line. And so in a very weird way, the retail guys are actually following this timeless advice, but the framing of retail investor, completely different ballgame. So you know what I want to do? One of my goals for 2026 is I'm going to do my best to reframe from retail to independent investor. Because that's what they are. They're independent, right? They don't have allegiance to any one company or idea. They don't have allegiance to any one LP or one shop. These people are thinking independently. They're thinking critically for themselves. They're trying to establish financial independence, and they are independently acting without all of the loyalties, allegiances, constraints, etc. So the independent investor, I think, is very, very well positioned moving into the future compared to the institutional investor, which has artificial constraints put on them because it's much more important to not lose the assets, not lose your job, than it is to drive returns.
100% agree that is what most people are looking for. Is they're looking for a fee. They're not necessarily looking to maximize return.
Yeah. Look, it's understandable. I get it.
Yeah.
What else you got?
All right. Let's switch gears a little bit. Government shutdown still going on. What is happening? Is this going to get resolved?
Did you know that the government was shut down?
Not really.
Like that most people don't know. Now, if you want to use a government service, right? I have certain things that the government is supposed to be approving or evaluating, et cetera, right? In terms of we have a public market deal, right? Well, with the government shut down, there's uncertainty. When is it going to reopen? What do you do? All this kind of stuff. There's certain services that people depend on from the government. They definitely know that the government shut down, right? There was talk of, are they going to have the money to pay the soldiers, right? And the military
people that work in the government definitely know it's shut down.
100%, right? So like if your paychecks come from the government, you're not getting your paycheck, you definitely know. So I don't want to dismiss the fact that there's some portion of the population that knows the government is shut down. But if you walk down the street and ask the average American, did you know the government shut down? Most of them will say some version of, oh, I kind of heard, is that still going on? I didn't know that. And then if you tell them like, by the way, it's been shut down for like 20 days, they're like, what? Like, I didn't know that. Like, you know, I'm just going to work.
Reopen it.
Yeah, I'm just going to work, right? So again, this is this weird dynamic. Like there are people affected. There are people who this is very real to them, but there is a very large portion of the population who like, they don't realize it. They don't even know. Financial markets, they don't care. A little sell off. But other than that, like, you know, we've been up and to the right. And so I think that it's nonsense, frankly. Like the government should open up. What I find very interesting, again, like put all your like political allegiances aside. I like to look at the data, right? I've been very clear that just for all people who think, you know, I'm one-sided, Joe Biden didn't get enough credit for how well the stock market did under his presidency. Again, you can argue why, was it good, long-term pain, whatever. Like stock market went up under Joe Biden. He should get credit for that. On the same side here, the government shutdown happened. You would think that when the government shuts down, the confidence or the like polls of the sitting president go down as well. People are pissed. Trump's polls have gone up during the government shutdown. That I wouldn't have bet on that. I wouldn't have thought that happened, right? So it kind of comes back to this idea of there is a change in the way that people view some of this stuff. They're starting to see it for what it kind of is. It's this like dramatized soap opera, you know, of politicians yelling and screaming at each other. Whatever. Like they're posting memes on the internet. Like these people do not look at it and say, oh, we have to like all get in a room and close this out, right? You have one side saying, we're not agreeing to this nonsense. You got another side that says, well, we're not going to move forward unless you agree to the nonsense. Okay. Let's see what happens, right? But my guess is, well, I know a deal will get done at some point, right? We're already pretty far. Like this wasn't like, hey, we shut down for 24 hours.
This is
right?
one of the longer shutdowns in history.
100%. I think the longest in history is 35 days. I heard from somebody that is pretty well connected in DC. Their bet was that the shutdown was going to continue until Q1 of next year. I mean, that would be another, 60, 70 days. That would basically put us like near 100-day shutdown. A lot of people will know the government's been shut down for 100 days, right? But I think that also if you look at the prediction markets, just recently I was looking at a Polymarket, the odds of the shutdown ending between October 23rd and 26th surged to over 40%. Now, 40% still means like it's more likely than not that it stays shut down, but that surge, somebody somewhere thinks they got some information. I don't know what the information is. I don't know who it is, but somebody thinks they got information to be willing to wager on the fact that it's going to reopen between October 23rd and 26th. So we'll find out. But as investors, there's some economic data that didn't come out, which might be a positive because it was going to be inaccurate anyways. But other than that, I think that the world kind of keeps spinning.
Yeah. When you think about it through an investor lens, that's kind of what me and you talk about a lot. Should investors really be worried that the government shut down at all? Or should it be more of a, hey, look, the government shut down, great. Stocks are still going to do their thing. Companies are still going to operate. Most companies are still going to operate within kind of like their realm of operations. Do investors even care? Like, especially the retail investor, if they're investing on vibes, why would they care?
Well, I think that some investors care for sure, right? Investors like certainty. And there is uncertainty introduced when the government is shut down. So when the government shutdown ends, I would expect enthusiasm to increase even further. I would expect investors to have more confidence to allocate to certain parts of the market. But I agree, like, again, the independent investor, they don't care.
It also depends. Are you a trader trading on day-to-day emotional, like short-term volatility versus, hey, I'm trying to wake up in 20 years?
Well, here's an interesting way to think about this. There's macro and micro politics to pay attention to, right? Wait, listen to what I just said. Not economics, politics. What do I mean? Is it more important for the government to be open or closed? Or is it more important for Trump to tweet or not tweet? I would argue that the stock market responds more to a tweet than it does to whether the government's open or closed. So all of a sudden now you say, well, that just puts immediate clarifying, kind of dichotomy of it is less important whether the government is open or closed for the stock market than it is whether the president tweets. Okay, so what are we talking about here, right? You can kind of pick up pennies in front of the steamroller, but you can be trying to trade all off the government, whatever. This guy tweets. He's telling the market where to go, right? Abracadabra, go up, go down. You may not like it. By the way, the other politicians, both on Republican and Democrat side, and past presidents, they've done the same stuff. They may not have used social media in the same way.
Press releases, press
conferences, announcement. Oh, come on, stop it. Joe Biden calling Jerome Powell into his office. Elizabeth Warren writing a letter telling him that he should be cutting interest rates. Trump tweeting at Powell. Trump tweeting about the stock market. They all are doing this stuff. It's modern communication. And so I think that you just got to update your view of the world, right? It's not a right or left thing. It's not a blue or red thing. It is just simply, this is the way that the world works now. Upgrade your software in your brain and, start navigating it.
It's not even a U.S. thing. That's the thing, is you start seeing China start talking about certain things and other presidents. Bukele is famous for his Bitcoin trade, right? And I think that provides two sides to the coin. One, it does provide uncertainty because one person has a lot of power, both across the world. But also it creates opportunity for one person to be able to communicate with so many different people and be able to say, this is our plan, right? You don't want to give away too much strategy because it basically lets the other person know your play. But ultimately, like the Bitcoin trade, like it doesn't matter if people know that you're buying Bitcoin. It's probably a good thing that Bukele and all these guys have bought Bitcoin and said they bought it out loud.
100% agree.
Okay. FOMC meeting next week. You expect rate cuts? Is it going to happen with the government shutdown?
FOMC? FO what? Cut the rates? I mean, that's all that's going to happen, right? Of course they have to cut rates. Listen, they can sit there and not cut rates. That's fine. They're going to get steamrolled by the labor market. Of course he's going to cut rates. And if he doesn't, it just proves that these people are numbskulls, right? Which I don't think that they are. I think that they're very intelligent. I think they look at the data, all this stuff. Before, people were saying, hey, the data is telling you something, right? I mean, how many times have we talked about, they used to say we're data dependent. Now all of a sudden they're like forecasting whether inflation is going to come or not. So they've changed their strategy, but the data is very clear. They should cut rates. Labor market has pain in it. There's issues here and they should address it. Now, if they don't cut, I think what you're going to see is you're going to see investors actually start to lose significant confidence in them because the Fed is now going to lose predictability. And a huge part of the predictability is if the data is telling you to cut and you don't cut, then how do we invest? Right? It's already hard enough when we don't know what the cost of capital is going to be in a year. If I don't know what the cost of capital is going to be in 3 years, how do I invest? What sectors? What is their borrowing cost going to be? All these inputs are determined by 12 people who go sit in a conference room that most people don't even know their name. But if the data overwhelmingly says you should cut, which it does, and the market is pricing in that cut, which it is, then the Fed doesn't cut. Hey man, we got a whole nother conversation to happen, right? So I think that it's pretty much a foregone conclusion. Now something could happen between now and then, so I reserve the right to change my mind if some external crazy event happens or
tweet happens.
Again, it goes. I mean, look, man, this stuff is crazy, right? Like, I like to wake up early, and so that means that you got to go to bed at like a normal hour. But if I go to bed sometimes 10:30 at night. If you're like a sports fan, hey, the game's on, I'm going to go to sleep, 7th inning, like, whatever, right? And I'll wake up tomorrow and I'll either watch the last 2 innings or whatever, or the football game, whatever. In the world of investing, you go to sleep at midnight, wake up at 6, bam, you're like, what? Who said what? Who did that? What? It's a 24/7 world. And so it's just, it is what it is. You just got to get comfortable with you got to sleep. You got to, there's certain things that are going to happen that you don't know about.
I hope you didn't go to sleep during the Giants game on Sunday.
Man, the New York Giants, I love them. Cam Scatterboo, Jackson Dart. It's just, it's like make New York Giants football fun again, right? Mm-hmm. How awesome. Amazing. But boys, you got to close out the game. You can't give up a huge thing, a huge lead. I think that I read the Broncos scored 33 points in the fourth quarter.
Mm-hmm. They were up 19-0 at one point.
Yeah, so we're gonna work on that. It's all right. But Cam Scatterboo, we need somebody to do some technology innovation. Make sure his helmet is good. That man, I love that man. He's just fun.
He's brute football.
He's like Pat McAfee and Rob Gronkowski put into one person, and he's good at football, which I love. But yeah, we need to protect that man at all costs because at this rate, he might not make it to week 12. I mean, he's just running over people and stuff. I love it.
All right, I got one more question for you. The Fed is extremely reactive most of the time. They're looking at data and they're saying, cool, what has happened? Should they be taking a more proactive approach to this stuff and trying to forecast? Because forecasts are normally always wrong. Doesn't matter who's doing it.
No. Because if you can't make good decisions based on the prior information, you guys are fortune tellers, right? These guys think that they're going to do some like astrology or something, try to figure out what's going to happen. They have no clue, right? I mean, here's the craziest part. I would love to sit down with somebody at the Fed and have an honest conversation and start asking them questions about what they think is happening in the economy. And I don't know, like there may be answers that I'm like, wow, I'm learning a ton from this person. They have an immense understanding and intricate, data, et cetera. On the other hand, half of me thinks like, I start talking and be like, bro, no wonder y'all are behind the curve, right? Both of those things are potential outcomes, which is part of the problem, right? There's a lot of places like if you go and you're like, if I go talk to Mark Zuckerberg about social networks, that guy probably got a pretty good idea. He probably understands the landscape really well. He understands what's working, what's not working. He understands inside the company, like great detail, blah, blah, whatever. If I go talk to, Jensen Huang about AI data centers or chips or whatever, like he's probably got a pretty good understanding. If I go talk to a Fed governor, I don't know. And I think that's part of the issue is there's a good chance. I mean, I'll never forget Jerome Powell saying when inflation was higher, he said, we don't think that inflation is a problem. It is not hurting people's quality of life. And they said, how do you know? And he said, no one's come to my office and told me. Oh, bro, stop. You won't let anyone in your office.
They're building a new office. Don't worry.
Yeah, $2 billion. All right, that's it for today. Thank you guys so much for watching. We'll do it again next week.